So it's not clear risk off trading across the board. It's not like, oh my God, this is terrifying, and pump all our money into safe haven assets. We are not at that. We are not getting clean, uniform moves across markets. If we were getting clear uniform moves across markets, looking at something like a terrorist attack or something like this, if markets are really going to sell off heavily, we would we'd need some cross asset correlations to play out. We'd want to see a sea of red across the Aussie, a sea of red across the Kiwi, a sea of red across the CAD, which we are getting at the moment. And Euro and sterling are kind of irrelevant when it comes to this risk on, risk off conversation. Risk off terrorist attack. You want to see yen strength across the board. You want to see Swiss strength pretty much across the board. To be odd. I mean, you look at like Swiss yen. This would be a bit choppy, and you might get one red, one green and stuff. But the majority of the rest of the currencies should be. I mean, these should all be green. Swiss and yen, if we're getting clear risk off move and a pump into safe havens. Come across to the dollar will be seen as a bit of a safe haven as well. Should in theory be down against the Swiss and down against the yen, but should be up against everything else. We've got dollar ZAR here, dollar against the South African rand. Emerging market currencies like the South African rand here, Russian ruble, Mexican peso, Turkish lira, these sorts of currencies, they will get hit as well. We'll have emerging markets down, commodity linked currencies, as I said before, Aussie, Kiwi, and CAD down, emerging market currencies down. You got safe havens up, like your Japanese yen, your Swiss franc, your US dollar, all up, and we're not getting that. And that's just across the FX markets. As we come across the equities, you want North American equities down, you want European equities down, you want Asia Pac equities down, which is happening at the moment, but it's not like they're down a great deal. I mean, the Dow's 0.3%, the Nasdaq's 0.37, the S&P's 0.39, DAX 0.34, 0.2 for the FTSE. It's not a great deal of movement across equities. So I mean, yes, they're red, but it's not like they're getting smoked across the board. You come down to commodities. Initial safe haven flows will go into gold. You'll have gold strength. You'll have gold. You'll have initial gold strength. If it's prolonged periods of safe haven flows, like like back when the pandemic first started, and you're getting 2 weeks of equity markets getting hammered, gold will not. People won't pump up money into gold for long term, for a couple of weeks. On an initial shock like a terrorist attack or something, yes, gold will be up, and it's only up $4 at the moment, so not a great deal. The rest of the commodities, you look at oil, natural gas, copper, platinum, these sorts of things. These are just the ones that I have on my watch list here, but commodities will be down across the board. They're seen as riskier assets. When investors are willing to seek risk, seek higher returns, they will buy things like commodities and they will sell them in times of risk off, like you would see off the back of a terrorist attack. We look at bond yields here. These are mixed across the board. They are bond yields, they are not bonds. So bonds will be bought. Bonds are the safest asset that money can buy. Certainly US bonds, things like German bonds, Japanese bonds, British bonds, very, very safe assets. So people will buy bonds, which will then in turn make the yields go down. So this should also be a sea of red across government bond yields, and then US bonds. This is just kind of the yield curve. These would be kind of green up across the board. So we're not getting clear risk off trading off the back of a couple of bombs going off in Afghanistan. In terms of going crazy, sell this, sell that, hold on to your horses. We're not getting clear moves across markets to indicate that we should be selling through lows.